The price you trust doesn't actually exist. Right now, there's a quiet contradiction sitting at the center of the global gold and silver market. The metal is real, scarce, finite, hard to move. But the price you see every day is increasingly detached from that reality. And that gap is no longer small enough to ignore. Before the 1980s, futures markets were designed to end with delivery. Metal changed hands. Then something shifted. Gold options launched in 1982. Silver followed in 1984. By 1992, electronic trading took over. Since then, most contracts don't end with metal at all. They end with cash. That sounds technical. It isn't. It means price stopped being set by scarcity and started being set by paper volume. And here's why this matters to you. Your savings, your purchasing power, and your sense of financial stability are anchored to a number that may no longer reflect what exists in the real world. But here's the part nobody says out loud. If the price is synthetic, then the risk is real. And that's where this story actually begins. What we're watching isn't a single market failure. It's a pattern. The core event is simple but unsettling. Today's gold and silver prices are discovered in a system where most trades never require physical metal. Futures contracts dominate, options amplify them, and electronic platforms allow enormous volumes to move in milliseconds. The result is a market where paper claims vastly outweigh real supply. Here's the critical framing. This isn't about volatility. It's about substitution. Physical delivery used to be the anchor. Now, cash settlement has quietly replaced it as the default outcome. That means traders can sell metal they never intend to deliver, buy it back later, and extract liquidity without touching a single ounce. On the surface, this looks like efficiency. Underneath, it creates a two-layer market. One layer is physical, constrained and slow. The other is paper, unlimited and fast. And the headline price comes from the second one. Notice what's missing from that price. It doesn't reflect industrial scarcity. It doesn't reflect transport bottlenecks. It doesn't reflect what it actually costs to secure metal in hand. So here's the question that reframes everything. If price no longer comes from reality, what happens when reality finally pushes back? Here's the first hard fact that changes how this market looks. The dominant price-setting activity in gold and silver today is not buying metal, it's selling contracts. And many of those contracts are sold without the seller holding the underlying metal at all. The fact is, practices like high-frequency spoofing and naked shorting are built into how the paper market functions. Large orders are placed to create the illusion of supply or demand, then pulled before execution. Other contracts are sold without metal backing them, instantly increasing paper supply. There's a concrete constraint that exposes this. Theoretical limits on gold held against contracts sit around 27 million ounces, yet paper trading volume routinely exceeds that level. The fact is, what's being traded cannot all exist. Now watch what that implies. If supply can be created digitally, price no longer reflects scarcity. It reflects leverage. Institutions can sell aggressively at key moments, push price down, then quietly buy back lower, generating liquidity without ever touching metal. Notice what's missing from this system. There's no mechanism forcing delivery. No automatic penalty when metal isn't there. Cash settlement resolves the contract and erases the problem. But here's the part nobody advertises. A market that never tests delivery never discovers its true price. And once that test begins, the dynamics change fast. Now watch how this escalates. Once paper pricing becomes normalized, behavior shifts across the entire system. What began as a trading convenience turns into a structural advantage. Price suppression stops looking abnormal. It becomes routine. And over time, markets adapt to something that should never have been stable in the first place. We've seen this pattern before. When guardrails are removed, leverage fills the gap. The repeal of the wall between commercial banking and speculative trading allowed institutions to deploy enormous pools of capital into commodities, not as hedges, as bets. Money that was never meant to absorb risk was suddenly underwriting it. This changed the balance of power. A handful of players grew so large that their positions outweighed entire national supply chains. Regulators existed on paper, but enforcement faded into the background. Practices that would have triggered alarms decades earlier became part of the noise. Here's why that matters now. Once manipulation becomes systemic, the market stops correcting itself. Price no longer signals stress. It hides it. Shortages don't show up as spikes. They show up as silence. This is how abnormal conditions get mistaken for stability. And this is where the story stops being about markets and starts becoming about control. The second proof is more disturbing because it exposes a contradiction that can't be smoothed over. On paper, the system claims limits, position caps, inventory thresholds, safeguards that imply metal exists somewhere behind the trades, but in practice, trading volume repeatedly overwhelms those limits. The fact is, paper, gold, and silver are exchanged in quantities that exceed what could realistically be delivered. Not occasionally, routinely. At the same time, the stated purpose of these markets is price discovery. Yet the structure actively blocks it. Large institutions publicly support orderly markets while privately using tools that inject artificial supply. They speak the language of stability, but act through mechanisms that depend on distortion. Here's the contradiction that matters. If prices truly reflected abundance, delivery wouldn't be avoided. But delivery is avoided precisely because scarcity is the risk. Cash settlement isn't efficiency. It's insurance against exposure. Notice what's missing again. There's no urgency to fix this. No rush to force physical settlement. No transparency push that would align paper claims with real inventories, because alignment would end the advantage. Once you see this, the price stops looking like information. It starts looking like containment. The pressure starts stacking fast. First, physical supply tightens. Silver isn't mined on its own. Most of the time, around 3/4 of it comes as a byproduct of copper, lead, and zinc mining. That means output can't just ramp up because price moves. Supply is rigid. Second, demand doesn't slow down. Industrial users keep pulling metal for electronics, energy systems, and manufacturing. Investment demand doesn't disappear either. It just changes form, shifting away from paper claims toward physical control. Third, the supply chain itself begins to fail. Large dealers turn away 5-figure orders because inventory isn't there. Smaller sellers are forced to buy back metal from the public just to stay stocked. This isn't a pricing issue, it's a presence issue. Notice how quickly this compounds: rigid supply, persistent demand, no buffer inventory, and a pricing system that doesn't signal stress early enough to correct behavior. This is what loss of control looks like in slow motion, not a crash. A squeeze that tightens quietly, then suddenly. So here's the question that hangs over everything. At this point, the story stops being abstract and starts getting personal. Because when a market disconnects from reality, ordinary people are always the last to be warned. You don't feel it through charts. You feel it through availability, through delays, through prices that change between the time you decide and the time you act. If you're trying to protect savings, you're suddenly competing with industrial buyers. If you're running a business that depends on silver, you're exposed to supply you can't control. If you're just holding cash, inflation quietly eats purchasing power, while the assets meant to signal risk stay artificially calm. This isn't about ideology, it's about friction showing up in real life. Orders that can't be filled, premiums that keep rising even when spot prices don't. The strange experience of being told something is cheap while being unable to actually buy it. That confusion is the signal. It's what happens when paper promises dominate physical reality. And if this feels familiar, Say so in the comments, because a lot of people are sensing the same thing at the same time. What looks like a market issue is becoming a lived one. Here's the part that rarely makes it into mainstream coverage. This doesn't persist because no one understands it. It persists because the system rewards it. Paper markets create leverage, and leverage creates control. When price can be influenced without moving physical goods, power shifts away from producers and users and toward intermediaries who manage flow, timing, and perception. Incentives do the rest. Institutions benefit from stability on the surface and volatility underneath. Managed swings generate liquidity. Liquidity generates profit. And as long as contracts can be closed in cash, the system never has to confront its own physical limits. Fear also plays a role. Forcing real delivery would expose shortages, reprice assets, and destabilize balance sheets. So instead, pressure is diffused, delays replace defaults, rules are adjusted quietly, the spectacle of an orderly market is maintained even as the foundation thins. This is why outrage doesn't fix it. The mechanism isn't broken, it's doing exactly what it was designed to do. The unsettling insight is this: markets don't fail when they're dishonest. They fail when reality makes honesty unavoidable. And that moment is never announced in advance. Now we're on the edge of something much bigger. Because right now we're staring down two paths that both seem likely but neither is certain. One path could involve heavy intervention as institutions begin to implement measures to prop up the system: price caps, temporary suspension of physical claims, regulatory crackdown. It could look like an effort to return to normal, a market frozen at a price range, stabilizing everything before it breaks wide open. But there's another path, one where intervention fails, where the market flips and the disconnect between paper prices and physical supply becomes undeniable, where a short squeeze could drive prices into the stratosphere, where institutions that assumed control suddenly realize they no longer have the leverage to dictate price. The world starts running on a different currency when that happens. A currency based not on promises but on hard metal. A revaluation of the system triggered not by desire but by collapse. We don't know which path we're on yet, but the momentum is building. The next move, it's already in motion. Here's the last piece of the puzzle, and it changes everything. When everything falls apart and prices reset, it will be more than just a crisis of confidence. It will be a reset of trust in currencies, in systems, and in value itself. The immediate aftermath of a collapse will look chaotic. A surge in demand for tangible assets will overwhelm everything. The rush to buy physical gold and silver will trigger a scramble to secure stockpiles that were never meant to be hoarded. But this reset won't be random. It will follow the logic of a system that's been carefully managed for too long. As asset prices skyrocket, institutions will try to control the narrative. Central banks may intervene, but their ability to stabilize will be limited by a simple truth: the paper markets they've created are disconnected from the world that runs on real goods. And what about the dollar? As the gold and silver market realigns, the dollar supremacy could start to waver. Not in a single event, but in a slow erosion of trust. When the metal market gets untethered from the system of digital promises, a new form of money might emerge, one rooted in something tangible. This is not a prediction, it's a possibility. But it's a possibility shaped by facts, facts that are already in motion. For those paying attention, the opportunity will be huge. The rest of the world, they'll be watching when it's already too late. If you want to keep following the story, make sure to subscribe. This is only the beginning.